Good morning and welcome to RIU Sydney Resources Roundup 22. Now, for those that were here last year, we managed to sneak through the conference only just, with your Premier closing it down on the last day. Well, our Premier has opened up and Australia is at one again. So hopefully there's no issues this year and we all get through. So welcome everybody and I hope you have a great show. Before we go any further, I'd just like to thank the One Nations people and acknowledge their leaders, past, present and emerging. We have two auditoriums this year, the one we're standing in now and the Fresh Auditorium, which is behind me, which will run for two sessions after morning tea and after lunch. So you have a decision to make on your program, which auditorium you choose to go into for those two sessions. You can see a large exhibition area behind me, in front of me, behind you, and the coffee station is right down the very end. And I make no apologies for the long walk, so you have to go and talk to all the booth holders on your way down to get a coffee. That's part of the deal. Have a seat, Andre. I'd like to now start with the sponsors. ABC Refining, second year involved, and they are a great sponsor. Obviously gold, and Nicholas Frattel is giving a talk after me here. So stay tuned for that. We're going to find out all about what's happening in the world of gold. We then go on to our other sponsors, Lind Partners, CRU, TEAS. So Terry, thank you for being involved. ALS, our barista sponsor, as we mentioned. METS, Max Geo, Geo's Mining Mineral Consultants, Core Plan for the Water, Pulse for the Cold Bar, which is just near the ABC Refining and Southern Cross Gold, the Fresh Equities for their auditorium sponsorship, and MEC Mining. We also have a whole range of company sponsors and media sponsors and supporters, which will all appear on the screen behind me. I'm not going to say too much today. It's time for me to get off the stage, except for, I guess I can't go without talking about, we're looking forward to the Fresh Equities, to the Waugh Resource Management Fund's keynote to close this session off, and he'll tell you everything you need to know about investing. So stay tuned for that one. It's going to be a beauty. And he may or may not touch on the election. I guess we can't go without talking about the election. I was fortunate enough to read a poll a couple of days ago, and the poll had who was going to be the winner come a few weeks' time. And the poll went like this: 1% ScoMo, 1% Albo, 1% Pauline Hanson, 1% the Greens, 1% Clive Palmer, and drum roll, 95% Humphrey B. Bear. So let's all support Humphrey, get behind him. I think he'd make a great Prime Minister. It'd be great for the airwaves to have Humphrey B. Bear in charge for 3 years, and we can get on with our life. So that's all from me. Thanks for coming. Enjoy your 3 days. Come and go as you want. Enjoy the coffee, enjoy the drinks, our sponsors, and have a great time investing. Thank you very much.
Thank you, Stewart. Good morning, everyone. I am your lady of the conference for the next 3 days. I'll be the one that's keeping everyone in check in this particular room in particular. My name is Christina and I hail from the goldfields in Western Australia. So I grew up smashing little rocks in the back underneath the washing line to get my fool's gold out, and I've been fascinated with the mining industry ever since. And I work with the ABC in their Rural and Resources report as well. I've also had the great pleasure of working with the 10 and the 9 network in earlier days when I was a younger woman as a news presenter, and now I just travel around the countryside doing TV programs to do with travel and also some with mining. So I'm very, very lucky. And my other half is actually a mining person. He's up in Newman at the moment, one of those famous FIFO people. So I live and breathe in the mining industry, and I'm always really pleased to be part of these conferences that Stewart put together. And no, Jerry isn't here this week. He does say hello to all of you. and he looks forward to seeing you all in the very near future. But we have got some fabulous tips to hopefully increase our little pocket full of money that we have that we're going to need to get us through whatever happens with this flurry election that is coming up. And there should be some interesting announcements made as well today. It could in fact be the first rate hike since 2011, so I'm certainly watching that with interest, but not as much interest as I'll be watching all of our presenters here today. A couple of little bits of housekeeping, if I can, please. One of them is please turn off your mobile phone, or at least pop it onto vibrate or flashing, whatever might be your preference for that one. Also, Stu pointed out the coffee is at the very, very back of the exhibition hall next to ALS, who of course are fabulous creators of remote mobile lab sites for mines. And there's also the New South Wales government up there and Widgie, a lot of people up the back of the hall who would love to have a chat with you. And that's a big bit about what we do here is all about. As you know, are there any Virgin conference goers here? Anyone who's never attended before? Put your hands up. Look, oh, there's a couple of you, fabulous. So one of the greatest things about this, of course, is getting to speak to the people who are out there on the ground, putting the drills down, making the decisions. So you actually talk to those people and get that insider information. All right, so 15 minutes each, our talks today. Let me check the time on my little computer, 8:40. Are we prepared to go early, sir? Should we go early so we can make up that little bit of time that some of us may take because we've got so many interesting things to say? I'm looking at our first presenter down the front here. There's been debate amongst the people in the hall as to whether he is rocking purple or blue today as he gets up, but he has got far more important things for you to notice about what he has to present today. So we're kicking off our Sydney Resources Roundup today. ABC Refinery, one of the sponsors that Stewie mentioned to us. ABC Refinery has developed into Australia's most technologically advanced precious metal refining, assaying and minting facility. They're featuring state-of-the-art equipment, security. They're actually the only independent LBMA accredited gold and silver refinery in Australia, and rightly coining that phrase, refining the gold standard. Nicholas Frappel is the company's global head. Today, he's digging into a number of topics, including the outlook for gold war, stagflation, the cost of money, and China. Would you please welcome to the stage our first speaker for 2022.
Thank you very much for such a kind introduction. Good day, everyone. First of all, I'd like to thank the organisers for the opportunity to speak here again. Today, I want to give a brief review of the gold price factors that played out since I last presented here in May 2021, and then I'll address the influence on gold principally by those factors, discuss key price points and their significance, maybe make a few gentle predictions and expectations for gold over the next 12 to 18 months. Now, since last May, the world has changed hugely in some regards. Defense think tanks speculate fairly openly on how NATO would likely respond in the event of a low kiloton tactical nuclear weapon being detonated over a Ukrainian city or a town, and at what point that would constitute a meaningful escalation of the conflict with Russia. And I think this has been scarcely imaginable this time last year. In other ways, the world remains unchanged. Asset markets continue to live in the full glare of the fiscal blast furnace that was fully lit in the response to COVID-19 and the post-COVID supply chain issues that have been intensified mainly by two factors. One is the war, and the other factor is the ongoing zero COVID strategy in the People's Republic of China. The expected pace of US monetary tightening and the likely terminal value before interest rates roll over exceed almost all prior beliefs, as I'll show you. Now, as real yields race higher from the 2021 lows, gold remains under some pressure, owing to the inverse relationship between real yields and the gold price. This, and to a great extent, the strength of the US dollar, which has exceeded my expectations even, helps to explain why both war and some very worrying inflation numbers haven't translated into fresh highs for the gold price. Just a reminder of the principal drivers of the gold price. Those are real yields, meaning nominal yields minus inflation, the US dollar and debt. They're not the only drivers of the gold price, but like my son in the lead up to Christmas, their influence is both powerful and persistent. Now, we'll quickly review what happened with the dollar and yields last year and now, partly because when I was standing here last year, the US dollar was close to multi-year lows. Lots of observers were calling it even lower, and I called it higher, so I feel I should enjoy a brief moment about being right about something. Debt has only increased, so I won't talk about that. It's just to say that it continues to be a positive factor for the gold price. And later I'll talk about war in China and inflation. Now, the US yield gap was one of the main factors in expecting a higher dollar price broadly over last year. And that yield gap has persisted and dragged the broad dollar base index higher. And it's accentuated, and I have to thank Deutsche Bank here for this particular research note, by a steep kink in the middle of the rates curve that drags more interest into the dollar. Now, the important issue with US yields is where do we go from here? The substantial tightening that is expected by the Fed will reduce the slope of the curve significantly, and it should diminish the appetite for US dollars relative to other currencies, taking the wind out of the sails, possibly taking the wind out of the sails of the ongoing dollar rally. So that's the first issue that might change relative to last year. The next issue was an important factor, an important driver last time, was positioning in the dollar. Last year, dollar positioning was extremely low and extremely extended to the net negative. And the net negative exposure like that usually presages a substantial rally in the dollar, and it did. So what's going on now? Now, these charts were made about a week ago because that's the pace at which the data comes out in this particular case. So things have happened since. But as of the moment when this chart was printed, positioning was rolling over. I think it's actually extended now since, which is not surprising given the recent burst higher in the dollar. But the point is that it looks like there's a degree of uncertainty, and it looks as though the red line, which is positioning, shows you a degree of perhaps loss of momentum. So finally, the third thing, and that is the cycle for the dollar. You can see a huge mega cycle, which I mentioned last year, which is about 39 months long. And this time last year, we were almost at the lows of that cycle. And given what had happened before, because history does tend to sort of cycle through, there was a good chance the dollar would go higher, and that would be a headwind for gold. If you look at what's happened now, and I think we may have even gone higher since last Thursday, the dollar's touching resistance, or touching a broad resistance level that extends back many, many, many years. It's also about a third of the way through the cycle. And whilst you can't assume symmetry, it does suggest a lot of what's gone has played out, and we might be near some dollar highs. And therefore, if we are near dollar highs and that cycle we begin to see the downslope of that cycle, we might actually see a weakening dollar, and so that's something which is good for gold. Real yields, they moved lower as expected. It was really hard to say how low they were going to go because we were already in pretty much uncharted territory, but they made a completely fresh low. I have to say, it was a long decline in real yields that helped gold hit the highs 2075 in August 2020. But since then, they've absolutely rocketed higher. And the reason they've rocketed higher essentially is the perception the Fed will stand on the brakes in order to deal with inflation. That move higher in real yields has been quite difficult for gold. If you look at the sort of purple box that I've put in there, we're now in that zone. That's the area where I expect the move in real yields to sort of peter out and lose momentum. So again, if you look forward from where we are now, this is another sign that actually the factors that were sort of headwinds for gold, the higher dollar, the move up in real yields, those two might be losing momentum and turning around. So the Russian invasion of the eastern part of Ukraine and the high degree of political uncertainty arising, not only from the immediate impact of the invasion, but also from what China will do or won't do, the whole Russia-China axis and beyond, looks to have decoupled gold from the main influences on the gold price that I just referred to. And if you look here, this is all data from last week, so it's actually quite telling given where we are now. All of those sort of red axes that intersect intersect quite a long way above the sort of regression points that you'd expect for the US dollar, real yields, and Brent, all of which influencing the gold price to some degree. So what it looks like to me is that when all this data was run, gold looked a bit overvalued and looked like a highly valued outlier compared to where you'd normally expect to find it. Gold's dropped about $100 and so since, US dollars since, or $80 since. So it's actually tended to converge on where you'd expect it to go, so closer to the regression line. I won't speculate too much on why that decoupling occurred, except that it's probably, to some extent, fear of inflation, and obviously to some extent the heightened geopolitical risk. Now, what happened in February, we had short-term moves that showed funds flowing very rapidly into gold as investors bought insurance against the initial uncertainty of the move into Ukraine. They were exceedingly quick to pivot away, though, once they could take substantial profits. Now there's evidence that funds are moving back in, sort of tentatively into the gold market. Just to give you an idea, funds started loading up at about 1806, 1844, and 1886, and they reduced those bullish bets between 1934 and 1997. So that sort of insurance, if you like, paid off quite well for them. Now, the real world outcomes and effects on gold from the war are largely through the obvious price shocks emanating from the energy space and to some extent metals and softs, agricultural products. Those outcomes are observable and expected, and other potentially destabilizing outcomes are not. A very summary take on the war as it regards gold is that it can be thought of as a stagflationary event, both raising the price level in the general economy and shrinking the world economy. Now, what I want to point out is something that's becoming rapidly obvious, and as was just mentioned, we might even see evidence of it today, is the rapid tightening that is a worldwide phenomenon. It's just happening everywhere. This is a huge development for asset markets, rapid change in expectations for the cost of money, and these changes have the potential to be epochal in character, given the both very high levels of public and private debt. The proximate causes are the culmination of years of loose monetary policy, followed by a substantial fiscal boost. The helicopter money that Ben Bernanke referred to was choppered in directly by the government, not by the Fed. There's an added and extremely important twist of the utter mangling of post-COVID supply chains. This slide shows 4 distinct data pictures that tell just one story. And the story is the previous era of cheap money is coming to an end. And the investors' decade-long love of risk is at last coming to at least a pause. Cheaper money, of course, might return if there was a significant recession. The slides here show the massive rise in Chinese high-yield debt yields, which is essentially a huge sign of risk aversion. The biggest spike in 30-year mortgage rates since 1980, the rise in Australian yields. The final bottom left chart shows the rapid change in market pricing of August 2023 Fed funds expectations. Last October, the market assessment of the probability that Fed funds would reach a target band of 3.25%, 3.5% was about as good as zero. Now the market prices in a 1 in 3 probability of that happening. That is not insignificant. And the chances of the rate stabilizing at 2 to 2.25% have all but vanished. Market might be wrong about this, but as of now, expectations are huge for worldwide monetary tightening. This is US gold positioning via managed money since November 20. And you can see that the insurance that I referred to earlier, and followed by the sort of the sort of slight exit, and now reasonably large return to the gold market. What I want to talk about briefly next is China. It's a story of lockdowns and deleveraging. The Chinese demand rebounded 57% last year to about 960 metric tons. Obviously, it was coming from a massively low base. But China's economy today is defined by 2 important factors that weren't really an issue last year. One is the imposition of zero COVID policies across major cities, Shanghai being the most visible exponent of the policy. Now Beijing and about 45 other cities likely to be affected. The second is the rolling over of the vastly indebted property market. Zero COVID policies are estimated to be impacting China's economic output negatively by about 4% per annum, just from Shanghai alone. They also have knock-on effects on supply chains that result in inflation elsewhere, but also worryingly in China itself. When I mentioned above that there are unknown destabilizing outcomes, high price of natural gas feeds onto fertilizer costs, and lockdowns feed onto the inability to distribute both the inputs for agriculture and food itself. To what eventual outcome only one can imagine. This slide here shows the Shanghai Gold Exchange premium and discount. I've smoothed it over 5 days because otherwise it just looks like an incredible lightning strike. But you can see when Shenzhen and Shanghai started lockdown, there was a significant drop in the premium and the move straight into discount. And if you talk to Chinese banks, they admit they can't even move gold, not only out of Shanghai, but they can't move gold within the vaults itself. Why the focus on China's property market? Reason why is the real estate sector accounts for almost 30% of China's GDP, and the slowdown there matters because it's estimated that about 51% of all investment in fixed assets was driven by real estate, and that 70% of China's household wealth is tied up in property. The sector is about $5.2 trillion in debt, according to Nomura, a Japanese investment bank. Although the government is sending supportive signals right now, it's entirely conceivable that the deleveraging that started this whole problem will begin again after the 20th National Congress of the CCP in the second half of this year. The short-term risk is that a highly leveraged property sector of gargantuan proportions shrinks and causes systemic problems that ripple through China's banking sector and impact local government finances and spending that hit President Xi's common prosperity plans. In other words, there's a risk of sharp contraction in Chinese demand, and that would feed into the stagflation sort of story that I'm putting out here. Now, the long-term risks are that demographics are creating a headwind that makes it harder for China to lever itself energetically out of a slowdown. And like Japan, China's ratio of working age population to elderly is similar to Japan's back in the 1990s. China will be hitting the same old age dependency ratio in 2023 that Japan reached back in 1992. In other words, slower growth may actually be baked into China's outlook. There is good evidence to say that stagflation currents are strong based on the aforementioned factors of war in China. There's also a considerable risk that rapid tightening will not only curb inflation, but also hinder growth next year and the year after. The broad-based dollar rally of 21 and 22 may lose momentum in the second half of this year. Real yields are expected to find technical resistance at 0 and certainly between 0 and 0.25%. And that suggests that the two traditional headwinds for gold could dissipate later this year and next year. Just very quickly, I'll deal with the multi-year view of the gold price. The recent behavior shows a distinct shooting star candle in the weekly chart that gave clear warning of a trend reversal. Gold bounced from the low, but we're still heading lower. Looking further forward, the weekly bar chart shows that a giant double top has emerged between 2020 and 2022. If gold breaks above the March high on stagflationary concerns, the measured target is about 2470 in US dollar terms. And this is borne out by our point and figure targets that suggest that the price can move up to 2500. Of course, we'll actually have to see how stagflation moves. I'll summarize the presentation as follows. The situation is something of the reverse of last year, where the dollar was in the early stage of a strong rally. Now that rally looks mature. Last year was reflationary. The economic outlook now supports stagflation, where growth is poor or even shrinks, but is accompanied by rising prices. This is a good environment for gold. Equities and bonds are under pressure after a huge period of growth, and the world economy faces a twin threat from tightening led by the US and deleveraging in China, both of which are underway. We can't know the full scale of those threats, but they represent a step change from what came before. Gold price targets remain ambitious and plausible above the 2021 lows. I'd just like to mention one last thing, that if any of you are interested, Shay Russell and I run a podcast that comes out approximately every week. And if you wish to sign up for it, you can do so here. Thank you very much.
Nicholas Frappel, thank you very much. I'm glad I gave you those extra 3 minutes, so you certainly needed it. Right, so let me clarify rules for our new players in the room standing up the back who are laughing and looking at their watch just then. You know my rules, you've got 15 minutes At the 13-minute mark, I will ring the bell. At the 14-minute mark, I will stand up, and hopefully I will never get close to you next to the microphone, because that will interfere with the fabulous live streaming that we are doing of you, our wonderful resources speakers here today. And that's a good reminder too. So if you're switching between this auditorium and the fresh auditorium, and you're thinking, gosh, there's something there I'd like to see as well, everything today is being live streamed and it's being recorded. So you may not get to see it live as you intended if two are clashing, but you will be able to see it back later. And then you can go outside over the next 3 days and talk to people in our exhibition hall as well. So you will get that opportunity, and you can go back and think, did I get that? Did I hear that right? Did I not hear that right? You can just sort of analyse it a little bit more, Clive. How come you were late here today, sir? How come you were late today, Clive Cutler? The dog ate your train ticket. That is no good. There are some spots down the front here. So if at any point during the day you're thinking, I don't want to be sitting up in the not so cheap seats up the back, and you could want to come down the front, we have water and little bits and pieces and a space to put your laptop so you can enter all that data when you need. Right, press and go. Coda Minerals is next up on stage here, and the smiling man who's making his way through the middle is Chris Stevens. He's the CEO and Executive Director. Now, Coda Minerals is building a large copper, cobalt and copper gold inventory at Elizabeth Creek, which of course is in South Australia. They're turning exploration success into resources in a copper bull market. Would you please welcome Chris Stevens, CEO.
Good morning. Thank you very much for having me. Delighted to be back here in Sydney a year. It's been a year since I've been back, and again, very honoured to be the first explorer to present to you today. Thank you to Stewart for everything that you do, and Stewart's team. It's just fantastic conferences these. Now, I will keep to time. I've got my stopwatch here, and there's a fair amount to get through, but the title of the slide last year was Rare Investment Opportunity as well, and it's funny how a company can actually maybe grow into that first slide, because when I spoke to the RIU conference this time last year, we were talking about 280,000 tonnes of contained copper in indicated resources, open pit, and I was talking about commencement of a drill program to really deliver a maiden resource at our underground deposit, Emmy Bluff. Well, in December last year, 5-6 months ago, just before Christmas, we put out our maiden resource, 43 million tonnes at 1.84%. Now, that's taken the total contained JORC tonnage across the tenure to 1.1 million tonnes, over 90% of which is in the indicated category. The scoping study on that work is now well advanced. You can only start the mining once you've got the resource, so it's been a very busy period. At the same time, I talked about a drill hole, which was really just a twinkle in our eyes, a deep drill hole into an IOCG target at Emmy IOCG. And I remember saying quite clearly, I got reported in the press as saying this might be the most exciting drill hole of my career to date. Well, I wasn't wrong. Exciting, challenging. It has delivered quite a lot for us, everything but sleep over the last 9 months. But again, that has given us a fantastic asset to be carrying forwards. So the rare opportunity really comes from 1.1 million tonnes of contained copper, an asset which frankly in a copper bull market will never not be of significant value in my opinion. In addition to that, the upside. So we've talked about the capping of the downside. The upside is that IOCG. We're on the hunt for Australia's next world-class tier 1 IOCG. The best place to look for one of those is right next to a whole group of intercepts, +2, +3% over 10, 20, 30, and in one case, 69 meters. And so the location is fantastic. We're in IOCG elephant country. In terms of corporate work, we have also created a clear path to the consolidation, 100% ownership of that asset. And we've also advanced our project in Queensland, Cameron River, significantly. And I'll talk about all of those in a bit more detail over the next 10 minutes or so. But fantastic locations, a strategic focus. Over the last year, we've demonstrated our ability to deliver on taking exploration, turning it into resources. And again, we're on the hunt for Australia's next major IOCG deposit. Corporate structure, still very tight, fewer than 100 million shares on issue as at today. Market cap around 60. Put that into context with 1.1 million tons of contained copper on the tenure. Shaw and partners have released independent research noting a $2.50 buy target based on EV over resource comps. There's a lot of work to go still. We're working on that, on the study. But again, in terms of that market cap, you can do your own research on the EV comps. Cash over $11 million in the bank, and we formed a path to consolidation of 100% of the asset. What this means really, JVs are a difficult place to be. I have enormous respect and, to be frank, fondness after 4 years of working together with Torrens Mining, but it made sense to put this together. No more tortuous budgeting processes, attraction for anyone looking at the project as a whole, whether it's as an acquisition or as a funding opportunity, as 100% is always better. And the end of me having to give evasive answers to every fund manager who asks us why we haven't done this yet. So we have done it. On Friday. The majority of the shares will be issued to the Torrens shareholders, issuing just over 20% of Coda to acquire 30% of our major asset. Seems like a pretty good deal to me. There will be fewer than 125 million shares on issue after the issuance of those shares over the next, the first tranche Friday, and then the rest will follow with the compulsory acquisition process. Quite certain no one can read these bios here. They're all on the ASX. But what I will say about this board, it has continued to steer the ship with good governance and making sure that the team delivers on our promises. Keith Jones, one of the most supportive chairs, I imagine, on the ASX, and Colin Moorhead, who's at the conference today, who just simply goes above and beyond in the amount of time he gives to Coda, amount of time he gives to mentor myself and support the company. So if you want to have a chat about Coda, Colin will be around as well in his various guises with Xanadu and Eris and Sahayo as well. I'm not going to sit here and talk about the copper market. I'm sure there'll be a lot of presentations on this. I will simply say that the time to be building significant resources, to be building a base, is now as we move into a copper bull market. And we believe very strongly. I think there's going to be some forecasters who realize they haven't caught up with the future. There are some headwinds. I think we saw some of those with China, but the rising tide of electrification, the move towards that, is only going to create a huge demand at the same time as supply deficit. I'm a proud EV driver, and I imagine most people's next car will be one. This is going to need a lot of copper, but also for the whole gamut of that. So back to Coda. In terms of news flow, what can you expect from us over the next 12 months? I've talked about what we've achieved over the last 12 months. Well, continuation of that hunt for a major IOCG. Again, if you're looking for significant scale, if you're looking for major IOC intercepts, best place to look for them, the Gawler Craton, right next to some fantastic ore grade intercepts. The copper cobalt study, the Zambian style, we sometimes call it. It's not in Zambia, it's in South Australia. Sedimentary copper may be a better term, but this is the 1.1 million tons, ESG friendly, in frankly the world's most forward-thinking sort of green energy jurisdiction. And that scoping study is advancing. Cowan River, another type of IOCG elephant country, fundamentally different type of IOCG, Mount Isa Inlier, an area that has delivered and delivered and delivered again over the last year for some of the companies, many of which you're going to see today, companies like Carnaby, Hammer, run by fantastic people, and we'd love to see that success. Will Coda also replicate that success? Well, we've just got to drill it at this point. Appreciate this is a busy slide. It's actually quite difficult to talk to the wealth of opportunity and existing assets on this tenure. Over 700 square kilometers of tenure, now moving to 100% owned in South Australia. A mixture of early greenfield sedimentary copper exploration right up to JORC indicated resources that I've been talking about. And so there's a lot still to go on this tenure, but the main game is at ME system. This is in the north of the tenure, a sedimentary copper and IOCG, so copper cobalt and iron oxide copper gold mineralization within the same system, possibly synergistic, we don't know yet. And a bit of a headache trying to explain this to new investors. If they were 20 k's apart, you'd probably spin them out into separate companies, but they're 400 meters apart. They're almost certainly a product of the same system. And it's very hard to put together a noddy, as Colin is famous of calling it, because you sort of nod your head and go, oh yeah, I get that. And part of that is the sheer scale. The sedimentary copper is sitting there in an unconformity, so between two sandstones. And the lateral extent of this is 2.5 times the size of Centennial Park. It's bigger than Kings Park in Perth, the world's largest urban park. Beneath that 400 meters is the IOCG intercept. So this is a huge, incredibly copper-rich system. And I think that's probably the most important takeaway. We have a JORC-compliant resource, mostly indicated at Emmy Bluff. And beneath that, we have a rapidly evolving exploration at the IOCG. In terms of the IOCG, this has certainly been an evolving understanding, and I think we're really starting to get a handle on this. The first intercepts last year in June 2021. It feels like 2 years, but it really hasn't even been one. 200 meters of intense alteration, 50 meters of sulfides, well over the ore grades of proximal IOCGs, so above the reserve grade, well above the resource grade of IOCGs in the area. Intercepts do not make a mine yet. And we are working on expanding this. We're working on understanding this. We now believe we're chasing multiple conduits. So we're a little bit confused because we saw this classic IOCG zonation where you go from pyrite, you sort of fool's gold, to chalcopyrite, a high grade, grade of copper mineralization, and then you bornite, the good stuff, the high grade stuff that forms the core of these deposits. What we're seeing now with a surprising intercept in ABD7 is multiple conduits, and that's backed up by independent analysis of the core. So we're really now chasing these conduits. We're up at the northern part of the tenure right now. The drill rig's about 50 meters, so just started on that hole. It'll go down to about 1,000 as we chase additional thickness. What we really see here is that within each zone, the thickness doesn't change much, but what we see is the tenor of the mineralization does. So in targeting a historical hole with much greater thickness than where else we've been looking at, we're really looking to make sure, that theory holds, and we're expecting to see a much thicker bornite-dominated intercept with EBD8. So watch this space. But some of the intercepts being returned from here, plus 3%, plus 2%, 69 meters, or well over 1.5 overall, 1.2 and 2% within that intercept. So this is really looking very good. And again, if you want to find a world-class IOCG ore body, the best place to look is right next to intercepts like this. Much of this has not been tested fully yet, so we do have work ahead of us. Zooming out a little bit, I think it'd be remiss not to mention the significant exploration potential for IOCGs across this tenure, multiple other targets. When you got a tiger by the tail, you don't go chasing other tigers in other parts of the long grass. And I guess that's what we're doing here. We're focusing on Emmy Bluff. We've got a tiger by the tail. We're really chasing that up. But there is more opportunity here as well. Back to the indicated resources, Emmy Bluff, again, 43 million tons at 1.84. We delivered that resource. That was really just the start of a drill program this time last year. And really what next? Integrating the existing open pits, the only assets I was talking about last year in terms of resources, into this new resource, finalizing a study. I've been working on metallurgy for 4 years as part of this project. We understand it. We've got a good handle on this. The underground mining study is now in the optimization phase, and we're working through that. There's a fair bit of work to do, but we are confident of delivering majority of the study in this early second half of this year. Just briefly onto Cameron River as I sort of wrap up the talk. Cameron River is another elephant country. It's a very different form of IOCG. What I love in terms of having a pipeline of assets, there's the existing JORC compliant resources. There's the fantastic upside potential of the IOCG. And then there's Cameron River. It fits in so beautifully. It's relatively shallow exploration. This isn't 800-meter IOCG. This is 80-meter kind of exploration. So it's cheap, it's relatively low risk. But as we've seen elsewhere in Queensland, this can be very high reward. These slides are a little bit wordy, so I apologize for that. It is available on the ASX. This is what happens when you let geologists loose with the slides. There's so much to talk about. It's very exciting. Simple message here. We have coincident anomalism between the IP. That shows the potential for this to go to depth. It's beneath the supergene blanket. The IP results showing that excellent rock chips and lithostructural mapping as well. Really just remains to drill this, but the IP is lighting it up beautifully. Look at some of these grades of rock chips, 26%, 20%. This is highly, highly prospective area. And we're frankly just looking forward to drilling it. That'll be August, subject to approvals, maybe a bit earlier if we can get those through. We do walk the talk on ESG. I'm very proud to sit on the Minister's Executive Committee for Energy and Resources in South Australia. This is a fantastic place to do business, and we believe very strongly in the future there. Supply chain premiums for cobalt especially, and a very strong relationship with the traditional owners, the Coda people. Very committed to ESG, also committed to finishing on time. So I will wrap up very quickly to say we have delivered over the last year. It's been a very fast-paced program. I think I've experienced everything but sleep over the last year. It's a great board. We're advancing the sediment-hosted copper with an existing resource and significant upside to come as we continue to follow up on the MEICG discovery. With that, thank you very much for your time.
Thanks so much, Chris Stevens, nailing it, our first explorer up here on stage for 2022. Well done, sir. New Century Resources has emerged as a leader in economic rehabilitation. They're actually operating Australia's largest hydraulic mining and tailings reprocessing operation at the Century Zinc Mine in sunny Queensland. Managing Director Patrick Walta is the man who's just joined us up on stage now, and he's going to discuss New Century's production and also their in situ expansion profile, as well as the company's transformational ESG-focused growth plans, which are centred on green copper mining down in Tasmania. Please make him very welcome.
Well, thanks, ladies and gentlemen, and certainly appreciate everyone's time in coming to listen to the New Century story. It's one that's evolved quite a lot over the last 5 years. Many people might be aware of the acquisition that was made, acquiring the Century mine back in 2017. There's been a lot of hard work done, and I'm really pleased to be able to present the results of what we've achieved to date. New Century has quite a unique offering for investors on the ASX and in the junior mining space, and it's one because we generate cash, and we generate a substantial amount of cash. So we're not pitching a story here of what might be the future. This company has cash flow today that underpins its valuations. It also owns its growth projects that underpin the future of the company as well, to grow and expand that valuation base as well. So I'll take you through those activities today. You can principally see them there on the map as well. We run the Century Zinc Mine there in Queensland, 15th largest zinc producer in the world. Over 800,000 tonnes, or we have produced over 800,000 tonnes of zinc concentrate from that operation to date without starting a new mine. So this is actually about reprocessing tailings initially. It's a fantastic initiative, very much green zinc, the offering that we produce. The cash flow we produce is very much has a green initiative to it as well. And our second project is down in Tasmania as well, there with the Mount Lyell copper mine, and I'll take you through that one today as well in our developments down there today. Just quickly giving you that summary of the Century mine as well. As I said, we're now one of the top zinc producers in the world from the tailings operation. Last quarter alone, we produced $40 million in operational cash flow. We're nudging the door of $100 million operational cash flow over the last 12 months. Average zinc price keeps tracking up on that, so we expect to expand well beyond that $100 million. And we also have a near-term development play in Silver King. So Silver King's another ore body that sits on the tenements at Century, and that we're looking to bring that into development shortly. Silver King's beautiful because it's so value accretive in that the tailings is paying all the bills. So we bolt on this additional supply out of the Silver King asset. It has ridiculously low all-in sustaining costs. C1's a negative 49 cents a pound because fundamentally something else is paying all the bills. So we have all of these Silver King-like deposits, which I'll take you through, which are bolt-ons to the main part of the story at Century, the engine room, the cash flow generating engine room, which is the tailings operation as well. Clearly well-defined mine life now out to 2030 and beyond. So many people I'm sure lots of people know the history of the Century mine, all the way from 2000 when Pasminco spent a couple of $2 billion on the infrastructure. Many people might know the story of the Century mine since we got a hold of it in 2017, where it was a relatively short mine life tailings reprocessing operation. That's now evolved substantially into a long mine life operation, obviously a smaller scale to what was done previously. But the fundamental strategy at Century is always about utilising the sunk capital and facilitating economic rehabilitation of the site as well. And we're now achieving that on a pretty grand scale. We're Australia's largest ever tailings reprocessing operation, Australia's largest ever hydraulic mining operation that's running. So develop some really good IP in those areas. I won't look too hard at go through too much information about the last quarterly. This is all available online itself, but all these pretty pictures and lines just really point to the fact that we made $40 million operational cash flow in the last quarter there. So we have about $123 million cash in the bank, no debt. That cash is growing strongly now as well. So obviously we can utilize that as part of our growth projects, as part of potential distribution plans for shareholders as well going forward as we continue to grow the business. The zinc market's pretty interesting at the moment. I'll take you through some of the events that are occurring and why the times are so good. If I think about when we acquired the project, the zinc price was about $1.50 a pound. It then halved over the 2.5-year period. It was a brutal time to be in zinc, but the times have come good again. So we're looking at zinc, and the zinc price itself is really under the stress of two black swan events that are occurring at the moment. So European gas prices are being driven by a lack of available power, and that's because of a preference to renewable energy, and then also the Russia-Ukraine crisis that's occurring. About half the world's zinc concentrate is actually smelted in Europe. So we produce a zinc con, let's say it's 50% zinc. That is sent to a smelter. The smelter heats it up to about 1,000 degrees and effectively melts the zinc out of that material to make pure zinc. So heating anything to 1,000 degrees is energy intensive. Where do you get that energy from? You get it from coal or gas or whatever it happens to be. So in Europe, power prices have gone through the roof. Cost of smelting zinc has gone through the roof. Smelters have started to shut down. It's pure economics that have occurred there. As those smelters shut down, there's less zinc available, price goes up there. And we're seeing that play out. You can see across this timeline here, zinc prices has risen substantially from effectively the COVID lows of March 2020, where it hit about 75 cents a pound, now all the way to just under $2 a pound. So fantastic time to be in zinc. For New Century, we're not resting on our laurels there. It would be easy just to kick back and say, well, geez, it's been some hard work over the last few years. Times are now good. We see this as an opportunity for our company to evolve. So we have these great cash flows. We've underpinned them with some hedging as well, but now it's time to get busy and actually bring on multiple assets. So Mount Lyell, Silver King, when you come out of this, this great period, how long does good zinc prices last? I haven't got a clue. It probably depends on how long the Russia-Ukraine war lasts for, to be honest. But we'll utilize these times to invest and grow into a multiple asset operation company. And that gives us better access to debt, better access to a whole range of other opportunities there, getting into that higher market cap class as well. A quick overview of the Century mine itself and looking at the assets we've got and how they're relevant in terms of Silver King. You can see here, this is the tailings asset itself. So we are currently utilizing this evaporation dam water. We're hydraulically mining these tailings. We just bring it back through existing pipework to this tiny little green shed here. Now that green shed's 250 meters long, to give you an idea. It's punching out the best part of 9 million tons per annum of tailings going through it. All that material goes up, or the concentrate that we produce goes up our concentrate slurry pipeline, which heads 300 kilometers all the way to our own port facility in Karumba, where we use our own transshipment vessel to transship it out. So Pasminco back in 2000 invested $2 billion getting the Century mine up and running, the big zinc deposit. And that ran as the third largest zinc mine in the world for 16 years. We acquired all of that infrastructure. We own it 100%, and we're using that to get a much smaller operation up and running. So we're running about 300,000 tons of zinc concentrate per annum in that same facility there. But the value of that sunk capital cannot be understated. If you think about it, the risk associated with and the probability associated with a company discovering a deposit, getting it approved, getting it financed, and then getting it up and running and hopefully having good market conditions. We've gotten through all of those because we're focused on the second ton that's been produced, not the first ton. The first ton is always the hardest, or the first ounce is always the hardest to produce. After that, incrementally easier. And that's really the focus of the business, which is the summation of sunk capital, really. Just looking across, so we have that operation running. That's what's generating the cash flow at the moment. On the mining leases itself, we're now bringing Silver King and East Fault Block online. So a couple of kilometres from the existing processing plant, power, water, services, all that stuff that's already there, we can just bring these operations into play. They run through a separate part of the circuit, so we're not talking about a fancy metallurgical blend here or anything like that as well. We're producing a second product. It's a lead product that's high in silver as well, very much in high demand in the market. So a great little bolt-on initiative to what is our engine room, that Century engine room for operations. Positioning of the company as well, as I said, we very much have an ESG focus in the business. We produce green zinc at the Century mine. A lot of people talk about the greenness of their company or what they do that's green. Well, we fundamentally have to produce it because we're producing it out of a secondary ore body, a waste product in there, supplying the market, offsetting other zinc that might be produced from a greenfield development for that reason. And it's very similar down at Mount Lyell. And you can see here, there's a summation of sort of the materials that we target. So looking in the clean energy metal sector, zinc doesn't get a lot of play in the sort of clean energy metal space, but it's actually quite very, very important in terms of the wind industry and coating. Zinc is principally used for galvanizing and coating mild steel. So when you think about big wind turbines, they're full of zinc. All you're looking at is zinc all over the top of those. So may not be as sexy as nickel or copper, but it's a part of that clean energy metals revolution. Similar to the silver that we produce, and equally as exciting, the copper that we're going to produce as well. So Mount Lyell is our next project, the next cab off the rank. You can think about it as a copy-paste of Century. So all the hard work, all the learnings, all the mistakes, and all the good things that we did at Century, we get to now apply those to restarting the Mount Lyell mine. Fundamentally the same process here. We've got a historical mine. It's had a very long track record of historical operations, actually been in operation for 130 years. Interestingly, someone told me the other day that the Mount Lyell mine was the most prolific copper producing asset in the British Empire through to 1950 before MIM came online. So a massive history in terms of Australian mining, a really important piece of copper supply. There's still a massive resource base there that is largely underexplored. Over 1 million tonnes of copper, 1 million ounces of gold in there. Again, we're not talking about a resource in the middle of nowhere. This is tier 1 location in Tassie, fully permitted on a mining lease with a tailings dam, with infrastructure all around it, 2 kilometres from a town that lives and breathes mining. Queenstown was built for mining as well. Very friendly jurisdiction here. So again, all those barriers, those probability barriers, those risk barriers to producing, restarting the operation, they've all been taken away. Lots of work to do, but it's right within our wheelhouse, which is about brownfield asset restarts. So using that sunk capital to just restart the mine and apply the skills there. It produces a really good quality copper concentrate, runs about 80 ppm arsenic. Historically, it's actually been used as a blending product. So Vedanta was the previous owner of this mine. They've owned it since 1999. I'll just, conscious of time, I'll take you through some of this info. Vedanta, since 1999, have been consistently producing all the way through to 2014. So this asset is a 20 to 30,000 tonne copper producer, 15 to 20,000 ounce gold producer as well, year in, year out, running all-in sustaining costs of about $2 a pound. And if you think about that now, well, hold on, 30,000 tonnes of copper, it's about 70 million pounds. $2 a pound all-in sustaining cost producer. Let's say copper's at $4, let's be conservative. Well, you're making 140 US a year off that delta there, just by restarting the mine. Why isn't it in production? Well, there's no technical reason that actually the mine stopped. So the mine stopped in 2014. It was actually due to poor safety records that occurred there. So very simple stuff that under Australian standards should have never occurred. And we've been able to, or there's actually been a coroner's inquiry about those safety incidents. We're now able to restart it using New Century's best-in-class safety record that we have. We run a TRIFR of 3.5 up at the Century mine versus an industry average of 7.5. Even the most basic safety standards there will be able to bring this mine back online there. So we can restart it. We can enjoy $4.50 copper and obviously generate some really good value for shareholders as well. The ore bodies themselves, the first targets of the two ore bodies are Western Tharsis and Prince Lyle. You can see outside those, there's a huge amount of mineralisation. You've got to start somewhere. Why would we start at those ore bodies? Because there's 28 kilometres of underground mine development already in place, straight onto the ore. So that's the rough calculation is about $230 million in capital invested in the underground development there. Again, money we don't spend in there. We, in the very near future, will be bringing the reserves back online. So you can see there the Prince Lyle and Western Tharsis resource numbers. And I think you'll find something similar coming out in reserves. So this is a big asset. And again, it's near-term production. We don't need to go get permitting. We don't need to build a plant, or we don't need to build a new mine or anything like that. The focus is now on rebuilding the plant. So the plant there is old. Portions of it absolutely will be bulldozed and modernised. But if you think about it, all the ancillary facilities are there. So admin, workshops, labs, all those things are quite fine and usable. Services, runs 100% hydroelectric power to it, water, all that stuff is there. What we're looking to rebuild is the crushing circuit, the grinding circuit, and the flotation circuit. Pretty bulk standard stuff. The flow sheet is as simple as copper can get. Mine, crush, grind, float. Produce a con, sell it. That's it. No SXCW, no fancy autoclaves or anything like that. Really good liberation chemistry, really easy metallurgy on this asset that's run for decades. So we're not sort of talking about this based on lab scale test work. This has had 25 years of operating history under Vedanta itself. Apologies, I've run out of time. It's a good thing I've just finished up. Anyway, we don't need to go through the copper market. Thank you very much, everyone. Yeah, please keep watching our announcements coming forward.
Good on you, Patrick. New Century Resources, they come and talk to you. That's the whole thing. They've got 3 days to talk to you. You've whetted their appetite.
We've got a
See
booth.
if those predictions from last year are going to come true for the future for you. Now, Rob Waugh, where are you sitting, sir? Rob. Rob is our next presenter up here on stage. He is a geologist. He's one of those geologists who found his passion late in life. He spent 20 odd years playing with the big boys, moved into junior exploration and thought, this is what I love. This is what, and it's actually what he's really good at. And he spent a lot of time making a lot of money for people. 2011, you might have just moved into this little company here in Musgrave, didn't you, with their IPO? You're a little bit excited. He's going to share some of the findings. Is it Q that you've been sniffing around? Would you please make him very welcome today, everyone?
Thanks, Chrissy. And thanks to Stu and the team. Pleasure to be here. Great to be back in Sydney. I'll take you through the Musgrave story. So the objectives for us for 2022, the main objective is to grow the resource base. So the intent for us is we've got a resource update coming out in late May, early June, and ideally a second one later in the year. So we want to get eventually through to 1 million ounces. We won't do that at the next resource update. We're hoping to do that later in the year. Basement drill testing at Lake Austin on the joint venture. We have with Evolution Mining as well, another key component of what we're doing. And we're continuing on our pre-feasibility level studies on a number of our deposits. And they will continue on these new deposits we're about to get resources on in the next month or so. Really, it's to define a nice, clear path to first gold production. That's our ultimate goal. Bit of a background corporately. You can see where we sit. Major shareholders, cash in the bank is sitting at about 13.2 million, end of March quarter just out, and a reasonable volume we have in our trading, about 1 million shares, roughly averaging. Our board, we have a very experienced board. The board's been with us for a long time, and we've added Brett to the board most recently as well with an engineering background. Both Graham and John are here at the conference. We're in the booth, so please come and have a chat to us. Our Q is our focus. So we're between Mount Magnet and Meekatharra. Underlying our existing resources, the Breaker Day and Lena deposits, very high grade, very close to surface. We're continuing to discover more gold. We're continuing to find new deposits. Again, we're focusing in the top 120 meters, obviously open cut material, near surface, very high grade. We think this distinguishes us too in the market. What we want to do is find that niche, and that niche in the market for us is high grade, close to surface. As you're probably all aware, average open cut mining grades in Australia are around that 1 gram mark. We're significantly above that. what we're doing is integrating our geoscience. So where we integrate gravity, magnetics, geology, geochemistry, and this image here is a gravity image, but gravity has been quite instrumental in defining our targets and integrating that with what we're seeing in the geoscience. And what it has done is identified a number of target areas along these linear structures. These blue lines here are structures, they're second order structures off this main north-south Cunningwarra fault. And on these structures, we're finding these gold deposits. And this has been important for us in defining this and understanding this geology. Some of the key areas we're looking at, one of the new discoveries here at White Heat and Mosaic is only 300 metres south of the Breaker deposit. And you can see some of the grades we're hitting there. There's 11 metres at 19.6 at White Heat, and then we hit a splay off that White Heat structure. And you can see that in this image here. This is the White Heat structure and the splay coming off. And on that splay, we hit intersections 15 metres at 112 grams. There was another 9 metres at 100 grams. And you can see from those depths, these are only 25 metres or so below surface. So very close to surface, very high grade. Just putting some of these deposits in context. So these are all relatively close together. Break of Day and Lena in here, White Heat Mosaic 300 metres to the south. And then we're moving down here to this Big Sky area, which is only about at 1.3 k's or so away. This is 2.6 kilometres long. We're getting gold over that whole 2.6 kilometres. There'll be a number of zones in that that are better than others. And we can see variability within grade. So we're getting intersections the order of 70 metres at a gram, again, very close to surface, but also 28 metres at 36. And there's some of the gold that we've got from the RC hole. This is some of the best looking gold we've seen in RC drilling on the project. You can see quite nuggety gold there. And we do get a lot of prospectors through this area. And this is a really prolific area for gold mineralisation. The Murchison is probably the third best gold producing district in Western Australia. Over 25 million ounces produced, and lots of gold. The first gold was produced in 1895 here. So, but the important thing is there's still lots more to be found. What you can see here, this is this Big Sky opportunity. We're looking at one component of that. We're getting a cross section on the right. The green are the mafic rocks, blue are sediments, the yellowy oranges are combinations of felsics. But we're seeing these multiple vertical red shoots, and this is the gold mineralisation, confined within about a 60-metre zone along those contact zones. We can see variability, as I mentioned, in the grade, some thick, low-grade 1 gram material, very amenable to open cut mining, but also the very high grades as well. We also see there's been really critical in the exploration work we've done here is this really thin zone near surface. This is what we call a hard pan. It's consolidated clay. It stopped previous explorers being able to see the gold mineralisation. So once we drill through that, obviously you get through that and then you get into the gold mineralisation. But that's prevented this discovery of these deposits being so close to surface in previous history. Again, at Big Sky, these multiple lodes, subvertical, which are the red zones, on this contact between mafic and felsic rocks. So you can see some of the grades there as well. Some of the higher grades, 7 at 8, 3 at 13. That 3 at 13, again, you can see is very, very close to surface, only 3 metres below surface here. So really amenable to open cut mining, should protract and relate to really good margins when we get to eventually mining this. We're also doing a lot of regional exploration. So we're building the resource base, and we're also doing some new regional exploration. And Amarillo is another prospect we found in this district, very close, only a kilometre from Breaker Day again, but some good grades coming up, really early stage, multiple lodes, subvertical lodes we can see there, but 7 at 23, including within there, you got a metre at 118. Some good grades, early stage. This will not make it into the resource update in May, June. We're still drilling on this. That'll come later in the year. And the mineralisation here is roughly around 300 metres long or thereabouts. So a number of things we're doing at the moment. Resource growth and conversion is important to us. As I mentioned, we have a resource update late May, early June, and moving through to an additional one later in the year. We're doing open cut mine design on the initial deposits, Breaker Day and Lena. We'll flow that through after we have the resources at Big Sky and White Heat Mosaic. Mining technical studies, metallurgy, waste and tailings. So there's a number of things involved in this PFS level studies. And these need to be done, it's important to note that these need to be done on all the deposits we find. So each one will obviously define the resources on and then go through this process. And the back end of that is the financial analysis. So we haven't put a time frame on that. First step is to get the resources out, grow those, and then get this work happening in the background. And this will mean that we can fast track the PFS later in the process when we get to an optimum resource level. What's important to note for us in this district is the infrastructure. We're in an area, there's a lot of existing infrastructure. You can see Mount Magnet to the south. We've got Meekatharra to the north of us. Musgrave's ground is in the purple there. And we've also just picked up some ground to the south of Mount Magnet South project. The road infrastructure is fantastic in this district. The Musgrave tenements at Kew are only 3 k's off the main highway that links Perth to the Pilbara. A number of operators in our district as well and operating mills. We have the Tuckabianna mill. Oops. So we have the Tuckabianna mill owned by Westgold here. The Ramelius mill at Mount Magnet, Silver Lake are over here at Deflector. Gascoyne are in here as well. So a number of operations in our district. Musgrave is striving to be a standalone operation, and we think building our resource base to over 1 million ounces will get us to that position. The other component of what we're doing is a joint venture with Evolution. So all the work we've been talking about to date in this presentation is 100% Musgrave. That's the green tenure, this area to the south. We also have 100% of this ground up here at mainland. And this area in between on Lake Austin, so it's a salt lake, a dry lake, is in joint venture with Evolution Mining. Some good results have been coming out of that program as well. Evolution have a diamond rig out there and an air core rig out there. So both looking at a pipeline of opportunities with air core and diamond drilling to define existing mineralization that we and they have discovered. High priority targets at West Island in here, and some recent very good results from basement drilling, high grades, and this mineralization here is in the regolith, so 68 at 1.5. And we can see that from this type of cross section here. This is the regolith mineralization between the cover, underneath the cover, and then fresh high-grade mineralization beneath. As I mentioned, 2 rigs out turning. Evolution are managing this program. They've taken over management in early January this year and are progressing that. What that has done too is identified a dolerite host unit. It's also the host type of rocks that host a number of large gold deposits within the Yilgarn, including Great Fingal and Golden Crown to the north of us. And that's this green unit that runs all the way through the centre of Musgrave's 100% ground in blue there, and then the joint venture ground in yellow. What we've been able to do is identify that this unit is significant to hosting gold mineralisation as well. And so we're following that back down into our 100% ground to the south in that purple area. And Evolution are also testing other zones within that dolerite along strike. We've recently picked up a package of ground to the south of Mount Magnet as well. Musgrave has a strong exploration pedigree and expertise, and we're utilising that. It was a relatively modest pickup. It's very close to the existing operations of Ramelius at Mount Magnet, and it's extension of 2 of the main structures that host mineralisation at Mount Magnet. And that's the Latecomer and Hill 50 faults as they extend south. Ground has been held by prospectors for a number of years, and so hasn't been in the public hands. The schedule of work going forward, We have RC drilling that started again this week at Amarillo, building that towards a resource, also testing new targets with that RC program. We've got air core drilling assays we're waiting for a target to the west of Lena. We've got a resource update, as I mentioned, at Big Sky and White Heat. Again, we're looking at high grade, close to surface. This resource will focus on the top 120 metres. Post that, we'll be looking at the high grade shoots below that resource. And that's why we think we can get a clear path to getting to 1 million ounces and beyond. But this resource update will be significantly less than that. But again, it's focusing on open cut materials and high grade open cut materials. We're doing resource definition, drilling and converting. We're converting inferred resources to indicated, and the joint venture continuing with evolution. ESG is an important part of what we're doing, as with all companies at the moment. And just to conclude, good infrastructure, good resource base, significant growth potential for the resources, exploration upside, great location, and we think we're in a pretty strong gold price environment. Thank you very much.
Rob Waugh, thank you very much. Okay. We're going to move south in WA now. Breaker is a well-funded emerging gold developer, and they're focused on a rapidly expanding greenfields gold system, which has been discovered 100 kilometres east of my hometown in Kalgoorlie. Now, a scoping study that was released less than a month ago is indicating a very robust and standalone pit mining project with extensive high-grade lodes discovered below that open pit resource last year. And this happy-looking man that's joined us up here to talk about the prospects for them and for us is Mr. Tom Sanders. Would you please make him welcome today, everyone?
Well, thank you very much for that kind introduction, and thank you, ladies and gentlemen, for your time today. This company started with a dream, and that is that if you live in Kalgoorlie for long enough and you see and hang around that red dirt long enough, you come to dream that there must be a lot of deposits hidden by it. That's very true. We happen to find one, and I'm sure there are lots more. Since discovery in 2016, we've drilled 300-odd thousand metres of RC and diamond. So that discovery is now a 1.7 million ounce gold resource that's still growing. It's part of a 9-kilometre new gold district. Now, we can carry on drilling, but the market and I think investors want to see some production happening. So what we're going to do is we're going to keep on growing it, but we're also going to get some production happening. We put out a scoping study a couple of weeks ago, and it said that we're going to have a 3-kilometre single open pit in one place with costs as low as $750 per ounce. That top 200 metres, we're getting an endowment of 4,000 ounces per vertical metre. And last year, during the course of the year, we've been discovering high-grade lodes sitting underneath it. That's only about 10% indicated at this stage because it is still relatively early in the drilling process. But despite that, and because of our learnings in the open pit area, which we hammered to the point where we understood it perfectly well, we understand what's happening at depth. So we've started preliminary underground studies. So that'll be coming out in the current quarter. But in the background behind that, we've already completed PFS level work covering pretty much all aspects. And that work to date has not identified any impediments to development. So what we envisage is a multi-stage open pit that will transition underground. Because of the recent discovery of the high-grade lodes below the open pit, our drill focus is there. We think we can get the grade higher at depth. It's already 500,000 ounces at 3.6 grams. And we can get more ounces. So the other interesting thing is this project, it is only 100 kilometres from Kalgoorlie. That area is supposed to be total brownfields, but this is totally new. So it's a virgin deposit, essentially comes to surface. It's only 5 meters away. And it's quite exciting. We're well funded. We've got about $31 million in cash and ASX listed shares. What is interesting is when you look at the metrics behind this, you look at what makes up the cash and ASX listed shares, you can justify our current market cap based purely on our non-core assets. This gold asset that I've been touching on is completely free. We discovered on our gold project a nice spodumene discovery. We dealt that to Global Lithium, who have good connections in the lithium industry. We maintain a 20% free carried interest through to completion of a bankable feasibility study. That's a positive one. Resource was declared there about a month and a half ago. And we expect to get up to $20 million in milestone payments prior to that getting into production. We also have a nice, interesting project out at Yalaring in the southwest Yilgarn, which is basically transitioning into a new gold district. So the breakdown of this presentation is a summary of the company and its assets in 3 slides, and then we can slow down. If I run out of time, I'm in booth 33, so come along, have a chat. The corporate overview is interesting. Okay, you can see the share price over the last year. I think one of the distinctive things about us is if you look at the breakdown of our register, you see some fairly serious US heavyweights on there, and that is unusual for a company of our size. Institutions like Electrum, Paulson's, Franklin Templeton. And I don't think they've invested in this company for a 10 or 20% markup. This is a company composed of explorers and miners. We've got a lot of experience at doing both, and we've had a lot of success at doing both. So there's a lot of capability there, and it is firmly aligned with shareholders. Now to look at some of the project aspects, some of the brown dirt I was talking about, you can see on the left. As I mentioned, the thin transported cover that conceals this deposit is only 5 or so meters thick. We're on the eastern side of the same rift that hosts the Kalgoorlie deposits. We're on the southern extension of the Laverton tectonic zone. We have big deposits along strike. So it's the sort of place that you expect to find a significant deposit. And our initial reason for being interested in this area is that we've got operating mines along strike. And the structures that control those mines, they hourglass in the area that we pegged. We got on the ground and courtesy of historical exploration, we found some nice quartz dolerite, which is great for hosting gold, and that was the start of it. So we pegged as much as we could. We did wide-spaced air core geochemistry, which I'll show you shortly, and that led us in. So we've been drilling away for about 6 years. I think what is important here, for each $40 we've spent, we've added an ounce of gold. So we've got consistent form here. We've been delivering ounces, and now we're gearing up for production. We've got our resource summarized on this slide. At the bottom, we've got a bit of a higher grade subset. So in that subset, we're well north of 1 million ounces already. Fantastic grade in the open pit area. That's defined above, around about 200 meters below surface. And early and very encouraging grades for underground. So that central picture that you see there is what the deposit looks like. There's no outcrop. So what we did is we did a lot of wide-spaced air core drilling, and that generated the image on the right in fact, that red background color is the air core geochemistry, because sitting on top of that, you've got your RC and diamond holes, all color coded for gold. So our initial production focus is on the Bombora deposit, which you can see there. It is about 1.5 million ounces. It is a typical dolerite-hosted deposit, like the Golden Mile. The lodes hit the magnetite-rich or iron-rich part of the dolerite, and because it's nice and brittle, the gold drops out. Same story precisely. We don't have exactly the same endowment, unfortunately, but the same geological story. And we expect this to transition underground. And to give you a feel for what that open pit is going to look like, you can see it there of the Optimum pit in magenta, and a larger pit below that, which is still making a lot of money, is in green. Scale. Okay, what we're doing here is looking side on at the deposit. It is quite big. You're looking around about 4 kilometres there. So the Sydney Harbour Bridge, around about 500 to 600 metres. High grade near surface, high grade at depth. It's a big system. And our strategy again was to focus on that near surface stuff, drill it to the point where we understood it. So when we go to mine it, we're not going to get surprised. And then take that knowledge and extrapolate it underground. And so what we are now seeing are these mineralized structures, in some cases, are over 2 kilometres. 2 kilometres of continuous mineralisation, very unusual. Optiro did our resource, one of the top ranked consultants in Perth. This is the model of the resource. We've got different lodes by different colour. You can see our drilling. You can see the drill density, very tight near surface, wide spaced at depth. So we're going forward, we're closing the spacing at depth and getting it ready for underground mining, essentially, while we're extending it. Now this gives you, this is a cross section. So what you're seeing here are flat lodes, steep lodes, west tipping lodes, mineralised widths 2 to 10 metres. So good width. But the interesting thing is those different colours you can see on the section, some of those go 4 kilometres. And that makes for a great mining situation and a de-risk mining no end. Ounces per vertical metre in the middle. To some extent, a function of drill density, but really that wide zone near surface and the clustering of lodes translates to good strip ratio and high endowment, just what you want for an open pit. This is a bit of a glimpse at the April open pit scoping study. You can see the larger pit covering the Bombora and Claypan deposits in brown. I've just got a little subset, our Northern Starter pit there on the right-hand side. You can see, what I can see is low strip ratios, high margin, good profitability. So for instance, mining that first stage open pit down to 160 metres, pre-tax cash flow, $246 million. You're talking about the northern kilometre of a 3 kilometre system. Interesting. Some of the high grade flat lodes, an underground miner would like this a lot. He would like the grade, he would like the continuity. He would probably prefer a steeper lode, which I'll show you shortly. But the advantage of stacked flat lodes is you can combine some of your development for individual lodes and make a lot of money while you're doing it. Steep lodes, typical steep load. This is our main Tura lode. It hangs together well, both in long section and repeatable grades in core tray. feasibility level metallurgy. We don't have any deleterious elements. It's not very hard, so it doesn't take much energy to crush it. Good gravity gold. So no difference essentially between the fresh part and the oxidized part. I won't talk about this, but you can read this at your leisure. It's sitting in the background. High value, again, this on its own, just to repeat, I believe this covers our current market cap. So our goal focus at the moment for the investor, and keep in mind the market isn't always rational in the short term, our gold asset is for free. This is a wild card, but this is a wild card that I think will translate into another discovery. So in summary, a big new virgin gold system with gold coming to surface, extensive de-risking both through the drill bit and other studies. We're well cashed up with a very strong register. We have imminent catalysts both on the resource growth side and the mining study side, with some very interesting stuff in our non-core assets. So if you get the time, booth 33, please. Love to see you there. Thank you very much.
Tom Sanders, you love the potential of that one, don't you? We'll go and have a chat with you out at booth 33. Certainly very convincing. If any of you are on Twitter and you want to join the conversation, if you can just hashtag us, it's RIU Sydney 22 or Sydney 22, excuse me. Azure, we're going to talk about now. We're moving from gold to nickel copper sulfide. Please take the stage, please. Tony Rovira. Tony is the Managing Director of Azure, which is developing its Andover nickel copper sulfide project, which is located, we're going back up north in WA now. We're staying on the west for a little while in the West Pilbara region of WA. Ongoing mineral resource definition, maiden scoping study in progress. To tell us more, would you please welcome Tony, everyone?
Thank you, Christina, and thank you very much, ladies and gentlemen, for coming here and taking the opportunity to listen to the Azure story, because this is all about the latest nickel discovery that we have here in Australia. The Andover nickel copper sulfide discovery is the first of what we believe is going to be many discoveries, many deposits to be discovered on our project. The usual disclaimer and statements, which can be seen on our website. Corporately, we've got a market capitalisation of about $100 million at the moment, just a bit over. We've got about just under $15 million in the bank. So the company is in a very strong cash position. And you can see there the major shareholders and the members of our board. One of the most important things that we have to consider where we operate in the Pilbara region are the local traditional owners and their customs. We have made a very strong effort and a very successful effort so far in building a very positive and strong relationship with the local traditional owners. We acknowledge their ownership of the country. The fact that we are working on their country is very important. And we make sure that we do things in a proper way to ensure that there aren't any negative consequences for anything that we do. So it's so far, and it's been going forward really well, is a wonderful relationship that's being built there. To expand out from the local community relationship to the wider ESG component, this is something that Azure is taking very seriously. We want to be able to operate in this part of the world in a very sustainable and a very responsible way, and we make sure that we do things in a way that is in accordance with the expectations of our modern society that we all live in. So the main Andover project is located in the Western Pilbara part of Western Australia, and shown there on the map. It's very close to the town called Roebourne. Roebourne is a small town of about 500 people. This is the main road that's driving into the town of Roebourne. You can see it there in the foreground. There's a hill behind it. Just on the other side of the hill, about 3 kilometres to the south of that hill, is our project. So in terms of local communities and local infrastructure, very, very well served there. And if we expand out slightly to the wider area, our Andover project is about 70 square kilometres. It's shown there as that blue polygon on the right-hand side of the image. And it's being in the West Pilbara, there is a huge amount of infrastructure that's there. Within half an hour's drive of our project area, there's everything you could possibly want for an exploration or mining project. To the south of us, we've got Rio Tinto and their iron ore mines. To the north of us, offshore, you have all the oil and gas facilities that are out there as well. There's airports, there's ports, there's rail, there's power, there's water, there's everything you could possibly want, all within probably half an hour of our project area. So you couldn't get a better located mining project anywhere in Australia. So let's zoom in a little bit and have a look at the Andover deposit itself. So we've come from the bigger picture right into the main deposit that we've just announced about a month ago. So the Andover project, this is a nickel, copper and cobalt sulfide project. The mineralization actually outcrops as a gossan, as a weathered and an oxidized representation of the sulfide mineralization that occurs at surface, at depth. And that oxidation of the material, of the sulfide material, only occurs in the top 10 meters. Below that, from 10 to 20 meters down, you're into the fresh sulfide mineralization. And that fresh sulfide mineralization, which is enriched in nickel and copper, continues to at least 550 meters below surface and still remains open. And there's a cross section there that you can see with the mineralization still remaining open at depth. The image on the left-hand side, that's an aerial photograph that shows the drill holes that we drilled into it. There's just over 100 diamond drill holes have been put into the Andover deposit itself for about 42,000 meters of drilling. The projection, the mineralization and the deposit is projected to surface as that red mustache type shape that you can see on there. And that mineralization is very continuous over the 300 to 400 meters of strike length and at depth and in width as well. So the mineralization has been drilled, as I said, with over 100 holes. We have now completed the initial maiden mineral resource for that. It's a very robust resource. Over 80% of the mineralization is classified in the indicated category. And that's because the drill spacing has allowed us to define it to that nth degree. And within that, the main part of the mineralization, the indicated section, the indicated component is shown there as red. And that mineralization is 10 to 20 to sometimes 30 meters wide in true width. And the continuity of the grade and the continuity of the width within that deposit is excellent. And there's an opportunity here with additional drilling to make this bigger. But at this stage, we say that this is good enough for this deposit. And we are now moving on to some of the other deposits where we're drilling. So the resource that we announced a month ago is detailed here. It's about 4.5 million tonnes of nearly 1.5% nickel equivalent, for giving us a bit over 50,000 tonnes of contained nickel, 20-odd thousand tonnes of contained copper, plus some cobalt as well. And within that main indicated zone, there is a higher grade core with about 2 million tonnes of nearly 1.8% nickel equivalent there. Very robust resource. Where to from here? We have we're just taking a little bit of a step back now. We're looking at the bigger picture. The Andover deposit is located in the bottom left-hand corner of our project area. So as I mentioned earlier, there's about 70 square kilometres of land. It covers a lot of what is called the Andover mafic ultramafic intrusive complex, which is a very old batch of intrusive rocks within which you have these cross-cutting zones of a late intrusion, which contains the nickel and the copper sulfide mineralization. So all of the mineralization that we've identified to date is hosted in that green corridor that you can see in the lower left-hand quadrant of the project area. And within that, we've drilled 4 different occurrences of nickel sulfide mineralization, 2 of which are now deposits. That's Andover and Ridgeline. 2 others where we've drilled, we've put some holes in, we've had good success in all of those holes. They're called Seaview and Skyline. We've got other examples there of the likes of Woodbrook and Atrium, and both of those have got outcropping mineralization at surface. And underneath that, you have these electromagnetic conductors that represent bodies of conductive sulfides at depth. So it's quite likely that in that southwest quadrant, we're going to have up to 6 deposits, 6 nickel deposits within that area. And that's why we're tackling this with an intensive drilling campaign that's been ongoing for 18 months now, and it's going to be ongoing for quite some time into the future. And then if you expand out from that southwest quadrant and you look into the rest of the tenement area, the rock type that hosts the mineralization around Andover does extend to the northeast, and that's those dashed lines you can see on there, and the red stars and the targets, which are labelled as VC 24, 30, 31, etc. Those are actual targets which we have yet to drill. We've identified them through the geophysics. We've identified them through the outcropping geology that we've got at surface, which contains anomalous nickel mineralisation. So potentially, this whole Andover project area itself has the potential to be a nickel camp or a nickel province in its own right. So it is in effect Australia's newest nickel district, containing at least one and probably multiple deposits. So one of the other areas that we're drilling now is it's called Ridgeline, and we've stepped about 200 to 400 metres to the west of the Andover deposit in that southwest quadrant, and Ridgeline is a blind deposit. It does not come to surface, but it's represented by, it was identified by non-outcropping EM or geophysical conductivity at depth. And we've drilled into those EM conductors, and we've been hitting very high grade zones of massive nickel sulfide mineralisation. And some of the drill holes there on the left-hand side, you can see 3 of the holes have been, which we announced recently, the results from that drilling. On the right-hand side, and this is really important, is a photograph of a couple of core trays that contain the massive sulfides. And on there, you can see that the grades of the nickel, the first couple of metres we went into, it was just over 2%. And then from then on, we were doing half-metre samples because we wanted to see if there was any internal variability of the nickel mineralisation. And you can see it's 3.5 to up to nearly 5% nickel in those samples through there. So this is going from, this is the Ridgeline deposit, which we're currently doing a mineral resource drill out on at the moment, potentially has grades of that are much higher than what we've already seen in the Andover deposit, which is right next door. So this is the upside here. Massive nickel sulfides at Ridgeline equal nickel grades that are in that sort of 2 to 3% range on average. So what's our company's strategy going forward? Well, it's a dual pathway. We want to run 2 pathways in parallel. We want to build up the exploration success, the identification and drilling out of deposits, the definition of more mineral resources. We're going to include and focus on doing a lot of drilling to up the mineral resource base of the project. Hence, we've got Andover deposit well defined already, Ridgeline deposit currently being drilled out, other exploration targets that will be drilled in the next few months and throughout the rest of this year. And then there's all the other targets that have been identified that need testing as well, which goes to our thesis that this is actually a nickel district in its own right with multiple deposits. But we don't want to miss the train that's in the station at the moment in terms of the high nickel prices that are out there. So we are developing this project as well as fast as we can. We have development studies underway. We've completed the first round of metallurgy last year. We've nearly completed the more advanced metallurgical test work that will be finished within the next few weeks. And things like geotechnical studies, mining studies, mineral processing and tailing storage facilities, all of those sorts of studies are in progress at the moment with the intention of completing a scoping study around about the end of this year based upon on the resources that we've identified so far and the further resources that we're going to get from the Ridgeline deposit. Part of that, as I mentioned earlier, was the metallurgy. The metallurgy of the Andover deposit itself is A class. It crushes and grinds, no trouble at all. It floats off 2 beautiful, clean concentrates. We get one concentrate is nickel and cobalt. The other concentrate is copper, getting very high recoveries in the high 80 to low 90% range recoveries. And we're also getting very high grades of those metals in those separate concentrates. And importantly, in addition to the high recoveries and the high grades that we're getting in the concentrates, there's very, very low levels of deleterious elements, which is important when you're actually looking to sell this product. And so everything we've seen so far in this project is positive. There are no red flags whatsoever that we've seen. So as far as the company is concerned and the project, we are married well together. It's the right sort of commodities to be in at this time. We control most of the Andover complex itself. And we've been able to build, because we picked up this project very early on, when sort of 2 years ago, we were able to not only get the good projects, we were able to get the good people before there became a skill shortage. Well, we were able to build the right sort of team of people that have not only great successful exploration experience, but also people that have built mines as well. And as I said earlier, we are in a very strong position cash-wise. So the intention of the company here is to grow the Andover project into a major nickel and copper sulfide mining and processing operation. And we foresee that we'll have multiple deposits. At the moment, as I said, we've drilled 4 targets. We've hit good nickel in all 4 of those. There's potentially a lot more that we've yet to identify as well. So a multi-mine operation feeding into a central processing facility to be able to produce a nickel and copper concentrate, sorry, a nickel and cobalt concentrate and a copper concentrate, which would then obviously be very attractive to the various downstream processors who are looking for those products. So the project itself is in a great position. It's advancing really well. We've got a really steady news flow happening at the moment. There's no negativity that we've seen whatsoever. Everything is looking really positive for developing this project into a mining and processing operation. And the company itself is in a really strong position as well, financially and team-wise as well. So thank you very much for the opportunity to tell you the story, and look forward to keeping you updated.
Thanks, Tony. I had the great privilege of going up to your little area and in Rover and saw the camps, etc. up there last year. We were filming. We're actually filming Red Dog. You guys know Red Dog? So that's Red Dog country, just out there behind where you are. So interesting. He's actually buried up there as well. But a beautiful part of the world to live in. And as you said, it's pretty easy to get people to go up there and work for you because it just is a great lifestyle up there. All right, we have one last presentation before we break for morning tea. And a reminder that when we do break for morning tea, we're going to split off into those 2 auditoriums. We've got this one here and we've got the fresh auditorium. So make sure you check your list of presenters, see who you want to see. And as I mentioned before, we are recording everything, so you'll be able to look back. Now, this fella here in front of us, he's got a couple of different hats, don't you, sir? Not content with one ridiculously huge skill of geology, he then went in for law. Or did you go the other way around?
I try and keep the floor a bit quiet.
You try? try and keep that one a bit quiet, do you? All right, so coming up here, we have John Forward. Now, he's the man you've all been waiting to hear from. John has a couple of hats, as I said, law and also geology. Geology is his passion that he's here to share with us, and it's helped him to maneuver through that world of investing, something that I know a lot of us are wondering, who do we invest in? Where do we invest in? He's going to answer some of those questions. So without me saying too much more, would you please welcome our next speaker, John Forward. He's Chief Investment Officer at Waugh Resources Funds Management, who invest in junior resources companies. As I said, a qualified lawyer, a geologist. He's got more than, are we going for 30 years experience, John?
Sounds like a lot.
Sounds good. Would you please make him very welcome today?
Thank you very much to Vertical Events and RIU for inviting Lowell to speak to you this morning. It's fantastic to see such big numbers in the audience. I think I hope that's a reflection of the state of the market and the interest in the resources sector. I'm not going to speak about our portfolio today, but it's great to be following on from a couple of our significant investments in terms of Azure and Musgrave, but I think all the speakers this morning had some fantastic stories to tell. So this is a quote which was made back in February by the head of Goldman Sachs Commodities Group, talking about the molecule crisis. And I don't think anyone would have thought back in April 2020 that this quote would have been made. When in April 2020, when oil price was negative, no one would have expected the markets to be as tight as they are right now. So this quote was obviously made before the war in Ukraine started. So when the war in the Ukraine started, about a month later, the commodities sector, or the commodities index represented by Bloomberg Commodities Index, spiked to had its highest 1-week spike on record, and that's a record going back over 60 years. But in terms of where we are, in terms of that commodity basket, we're way behind where we were in 2008, pre the GFC and after the mining boom of the 2000s. And we're way behind where the Dow Jones and equities in general have got to. So we think that there's potential for the commodity sector to be just getting started. So what are the reasons behind where we are at in this very, very tight and high commodity price or relatively high commodity price environment? Firstly, inflation. Commodities always do very well during times of inflation, and we've seen inflation breaking out all over the world. Here in Australia, we've hit 5%, but in the US and UK, they're hitting 7 and 8%, and in Turkey, they're hitting, for example, they're hitting many multiples of that. I think the big one, which is the long-term one, is underinvestment. We've seen during the 2000s mining boom, we saw a lot of capital spent, which perhaps was ill spent. But over the last 7 or 8 years, we've seen a real dearth of capital going back into the sector. And in fact, we've also seen a dearth of M&A and something that we've been looking out for, and it's just not happening. And why is that? Well, I think a lot of companies are, they're paying dividends, which is great and somewhat unusual in the resources sector. They're even doing share buybacks, and some of them are investing out of the sector, in particularly the fossil fuel sector. A number of those guys are looking to diversify out of their own money-making businesses. War, as we've seen in Ukraine, war has supercharged a number of these commodity prices. We saw that with zinc. Patrick Walta illustrated that very nicely. We've seen nickel have a real squeeze, and we've seen gas, particularly in Europe, also having a massive price spike. Decarbonisation, I won't go into that too much, but as mentioned, a number of fossil fuel companies are moving out of their own business into renewable energy. And we're seeing very, very strong prices for things such as lithium, but also other battery metals such as nickel, copper, and cobalt. Fiscal and monetary stimulus, we all know what's been happening there, but that is a big factor in driving demand and keeping demand very strong. And supply chain disruptions forced on us by COVID mean that getting metal to the end user has become much more difficult. Then China, I've got a asterisk against them. Obviously, they're a very big source of demand, but it seems as though they're sitting in the car at the starting line with their foot jammed on the brake and on the accelerator at the same time, locking up many of their big cities, but also announcing some very, very significant stimulus. So when those lockdowns end, we could see that economy take off like a scalded cat. And then finally, anti-globalisation, that has a positive and a negative, particularly here in Australia. It's very positive for other Western countries looking to source a supply of commodities from if you like, a safe jurisdiction. But overall, anti-globalisation will probably have a negative effect on the world economy. On the downside, what are the things that may be holding us back, and what may put a bit of a dampener on the commodities and resources sector in the future? Well, rising interest rates. Obviously, the cost of money goes up, the price of equities gets impacted. But as I'll show in a minute, rising interest rates and where we are at in the interest rate cycle is actually not a bad place to be for resources. Cost escalation, we're hearing about that quite a lot in terms of if you need to build a project, or even if you just need to get a drill rig or a geologist, margins are being squeezed a bit by OPEX and CAPEX rises. And the strong US dollar, look, the US dollar index is at 104, which is at a 20, or hit 104 last week, which is at a 20-year high. The last time we had levels of the US dollar at this sort of level, which was 2016, slightly below where we are today. Metal prices and commodity prices were, around 30 to 40% lower. So we're seeing something a little bit different, I think, in the current markets, where you've got a strong US dollar, but you also have quite a strong gold price at the same time, which is relatively unusual. So
what's been happening this year on the markets? Well, this is the sector that we at Lowell like to follow, which is the junior resources sector. You can see that ASX Junior Resources Index is up 16% to the end of April, whereas the broader market, as represented by the Dow, was down 9%. So that may represent a rotation from other sectors into the resources sector. And if that is the start of what's happening, that could be very, very significant for resource company prices, because the resource sector is actually very small on a global scale. And if you see significant global monies flowing into that sector, you know, it's almost the sky's the limit. So I know there's no questions, but I do like to have a bit of audience participation. So I'd like to have a show of hands. I do have an answer to this question as to which commodity may have the best price performance over the next 12 months. I do have a bit of an answer on the next slide, but perhaps we could have a show of hands out of gold, oil or coffee, three very different commodities. Which ones do people think will have the best price performance over the next 12 months? So could you put your hand up if you think gold will have the best price performance? All right, I reckon that's maybe 15, 20%. How about oil? I reckon that's about the same, 15 to 20%. So there must be a lot of worried coffee drinkers here. Yeah, definitely. I think coffee's the winner, if you like. Well, actually, I've got good news for you guys. So this is the last two federal interest rate hiking cycles. So we've just entered the start of an interest rate hiking cycle from the Fed. And as you can see, commodities in general do very well during an interest rate hiking cycle. However, coming in third out of those three commodities is actually coffee, the Arabica blend. So you can rest easy, the coffee drinkers. Next out of those three is gold. Gold bugs, you know, you can be happy, but the one with the best price performance and what we've really already seen so far in this cycle is oil, and at least out of those three. But just quickly, a lot of people would have already seen this slide, but the invasion by Russia of Ukraine has resulted in a lot of sanctions against Russia, in a lot of different commodities, and this just shows the commodities which Russia is a major producer of, and there are many of those. And I'll just touch briefly on a few of those in this talk: gold, oil, and gas. So this quadrant table shows the relationship between inflation, whether it's rising or falling, and interest rates, whether they're rising or falling. And right now, what this table shows that we are in the sweet spot for commodities. So commodities do best when inflation is rising and interest rates are rising. And possibly the next step will be when inflation starts moderating, but interest rates keep on rising, and commodities will still do well historically, and that's based on the last 4 interest rate hiking cycles. So just turning to gold, which is one of our favoured commodities at the Lowell Fund. This slide shows the periods before and after the start of Fed interest rate hiking cycles. So on the left-hand side, you've got the bars, you've got gold in goldy brown, you've got US stocks in green, and you've got the US dollar in red. On the left-hand side, you see the periods 12 months and 6 months before the start of an interest rate hiking cycle. And you can see that in that period, generally US stocks do the best out of those three. But where we are right now, which is the 6 months after the start of interest rate hiking cycle, gold actually does the best, and it continues to do well in the year after that start of that hiking cycle. So interest rates, I've talked a bit about that, but real interest rates do have a strong negative correlation to gold. But you can see just recently that real interest rates have jumped up as the Fed starts to hike its interest rates. But gold has actually maintained a very strong price, and that's quite interesting. And maybe that what that is telling us, maybe what the gold price is telling us, is that the interest rate hiking cycle will not be a prolonged or significant one. And we think that there's quite a good chance that that may be the case. And the reason for that is there's so much debt around. Everyone is aware of this, but generally when inflation is high, but also public debt or even private debt is high, you don't see a big jump in interest rates just because the economy just can't bear it. There's some data on gold from the CPM group out of New York. It shows that actually gold does, as you expect, gold does very well when real interest rates are negative. It also shows that it takes real interest rates of around 3% to really impact negatively on the gold price. And that would mean, for example, that we had inflation at 10% and nominal interest rates at 3%. Where we are now is right here at basically a 0% real interest rate. And that is the best place for the gold price on a historical basis. Nicholas in the first talk of the day talked about stagflation. Yep, look, I think, we think that there's a decent chance of that occurring. So what should you buy if you think that stagflation is on its way? Well, the answer is also gold. This is my favorite chart. I just thought I'd throw it in there. It's the gold beer ratio. It does show that gold is a little bit high compared to a glass of beer at the Oktoberfest in Munich. But this chart is a couple of months old, and I think with inflation having taken hold in Germany, we may see gold pretty much back at its long run price in relation to beer. So I mentioned earlier just about underinvestment by the industry. This is a chart showing from Crescat Capital showing we're at pretty much a 19-year low of investment by the industry back into its own business. Quickly on energy, you can see energy across the board has had a very strong run. Fossil fuels, but also electric vehicle related things and uranium, all very strong. And the reason for that is in oil's case, very low stockpiles. Here's the total oil inventory in the US going back 8 years, and we're at very much a low point there. Similarly with the Australian exploration sector, we're a microcosm of that. We've just seen spending fall off a cliff. And you're seeing, for example, gas prices go through the roof. But the demand for oil, look, I drove to the airport in my internal combustion engine car this morning, jumped on the plane, which was definitely not fueled by electricity. The demand for oil has been growing inexorably. It may start to taper off at some point, but really at the moment, if you're not investing in that industry and demand is growing, there's only one thing that's going to happen to prices. Finally, at Low Oil Fund, we like to invest in junior explorers. Why do we do that? Because they're the ones who make the discoveries, and discoveries is where you can really add the most value. In terms of the fund, I won't dwell on that, but if you'd like to come and talk to me, I'll be at the cold drink fridge at 5:30 each day after the conference, and love to have a chat to you about commodities or the market. Thank you very much.
Thanks, John. Where is the cold drink fridge located?
I believe it's just by the entrance to the main exhibition area.
Fantastic. We'll see you there at 5:30 each day. Put your hands together again, please, for our keynote speaker. We've got a half-hour break. Please use it wisely, and I'll ring the bell and we'll be back in here at 5 to 11. Thank you, everyone.